Hi, everyone, and welcome back to Stop Being Sold. My name is Michelle, and I'm here with Brian. And in today's video, we're going to do a deep dive into MYGAs, or Multi-Year Guaranteed Annuities, and share with you what you need to know about MYGAs so that you're not locked into a contract that may cost you way more than you bargained for down the line. So whether you have an annuity, you are thinking about getting an annuity, or someone is trying to sell you an annuity, it's a mouthful there. You really want to stay to the end of this video, because what we're going to cover, pros, cons, how it works, etc. It's really, really important to understand what you're buying.
Yes, Michelle. This video is going to be a part of a larger series we're doing called Annuities Exposed. And Michelle, I've been in the business for 25 plus years now, right? And with so many different types of annuities out there, and the complexity of them, they're difficult to understand. Sometimes you just don't know what you're even buying, right?
Exactly.
So let me ask you a question, Michelle. How many annuities do you think were sold last year?
Well, my first answer is a lot, but I'm going to go with something, maybe I had to guess, maybe a few 100 million.
How about $254.8 billion of annuities were sold in 2021, according to LIMRA, which is the Life Insurance Marketing and Research Association.
Okay, I was way off there.
I knew there was a lot sold, but I didn't think it was that much sold. Okay. And annuities are a big business.
There they are.
And they are a great product for the right person, especially, Michelle, when they're customized to the consumer's needs. Okay.
Right.
And this is why we really wanted to run this series, Annuities Exposed. But today we're going to cover the first one, which is the simplest, which is a MYGA. So,
okay. All right. Well, before we dive in and we get to what are MYGAs and how they work and all that jazz, if you enjoy the content of today's video, hit that like button, please. Also, subscribe to the channel and make sure you hit that notification bell so you never miss another video from us on how to stop being a transaction and become a more informed consumer with a solid financial future.
Definitely.
Now that we got that out of the way, hit that like button, subscribe. Brian, let's get into it. What are MYGAs and how do they work?
Yeah, like you said, first, Michelle, MYGA stand for Multi-Year Guaranteed Annuities. Okay. I call these the simplest annuities that you can buy out there. Okay. They're, like other annuities, Michelle, they're a contract between you and an insurance company. They're a type of fixed annuity that focuses on accumulation of your savings versus creating an income stream. Okay. And Michelle, you can see these from anywhere from 1 to 10-year time frame of these annuities. So,
okay. So how do they work?
Okay. So MYGAs work this way. In simplest terms, usually pay a lump sum of money to an insurance company, and they give you a specified amount of interest for a certain number of years.
Mm-hmm.
Kind of sounds like a CD, doesn't it?
Yeah, exactly.
So like a CD with an insurance company. Anyways, for example, let's say you deposit $10,000 to ABC Insurance Company for 5 years, and they guarantee you a fixed rate of 3% interest, right? At the end of the 5 years, Michelle, you can take your money and run, renew again at the new offered rate, or transfer to a higher paying MYGA at that time. So it's pretty simple. Here's your interest. Here's your time frame. Deposit your funds, and you know exactly what your return is going to be at the end of the term.
Got it. Okay, so MYGAs are used for accumulation of assets, like more of the savings thing rather than creating income streams for life like you see with other types of annuities.
You're exactly right.
Okay. All right, let's dive into the pros, or the advantages of MYGAs. Can you list a few of those for us other than, saving?
Well, here's a big one. How about tax deferred accumulation of your savings? Okay.
There you go.
These annuities, they're annuities, so they're going to be tax deferred. They're set up like a retirement plan. They're tax deferred. So you start taking either income off of them or you cash them out, right? So typically they got higher rates than most CDs. And a huge difference between them, CDs and annuities and MYGAs, Michelle, is that with a CD, at the end of each year, that bank sends you a 1099 for the interest earned during that year.
Sure.
The MYGA doesn't. The MYGA is tax deferred until you start taking the funds out. So you're increasing your savings by going into the tax deferred accumulation of savings in a MYGA. So there's one of the big pros or advantages. Also, you get a guaranteed interest rate for specific amount of time, like 3% for 5 years or 3.5% for 7 years, whatever it may be.
You really
know what you're going to earn.
Exactly. That's it. Nothing changes.
That's it. Simple. Less risk than stock market products.
Mm-hmm.
Unlimited contributions to non-IRA accounts, allowing you to save more. Traditionally, we've talked about in the other IRA accounts, the $6,000 limit or $7,000 if you're over the age of 50, right? Well, with non-IRA MYGAs, Michelle, you can drop 100 grand into it, 200 grand. I know people that layer these out for multiple years. So unlimited contributions in there. Also, many of them, Michelle, have penalty-free withdrawals of your interest annually with some of them. And then other ones have penalty-free withdrawals of up to 10% of the principal and interest every year.
Got it. Okay. All right. So if you needed some cash, you could pull some of it out.
Some of it out.
You don't have to cash out the whole thing.
Right. And think about this. In comparison to like a bank CD, Michelle, how many people stick money into a bank CD with the intention of withdrawing it out before the end of the term?
Nobody.
No. So there's one of the biggest benefits of MYGAs. You're going to earn a little higher interest rates and it's tax deferred. Leave it in. I mean, and put a designated amount in there that's not your emergency fund. So we talk about that all the time. So,
all right. So what are some of the negatives of MYGAs?
Pretty simple. Surrender charges, number one.
Mm-hmm.
Surrender charges, for those of you that haven't watched our annuity videos before, are a penalty that come into play when you surrender an annuity contract before the end of the term. They're usually on a percentage basis and decrease each year of the contract. So Michelle, if you had a 10-year annuity, and I'm here in the state of Texas where we're under what's called a 10-10 rule, meaning that no annuities can be longer than a 10-year period. And the first year penalty can be no higher than 10%. So that's why it's 10-10.
Okay.
So a 10 year is 10% and it goes down the next year, 9, 8, 7, 6, until at the end of the term, you have no surrender charge.
Got it. And it's important to note here. I mean, we were talking about MYGAs specifically, but surrender charges apply to all annuities.
Yeah. Yes.
Yeah. Again, read the contract, read the fine print.
Read the contract.
Right. All right. So what are some other, I don't know if I want to call them negatives, but maybe disadvantages?
Just some disadvantages. Okay. And you have to know these before you're sold an annuity or you buy an annuity. Okay. So let's talk about this one here because this one is big. Market value adjustment, or an MVA. Okay. Market value adjustments are, according to annuity.org, we just gave you a plug, a monetary adjustment that can be applied to annuity contract if the annuitant makes withdrawals beyond the allowed limits during the surrender period. And we just talked about the 10% free withdrawal for some of these, right? Well, if you go over that, this is where the MVA could come in, okay? To me, though, market value adjustments can be both a positive or a negative of an annuity contract. They have an inverse relationship to interest rates. When you surrender an annuity during a rising interest rate environment, the market value adjustment, or the MVA, could actually increase your surrender charge. Let me repeat that. When you surrender an annuity during a rising interest rate environment, and let's say you had a 10-year, 10% first year withdrawal surrender charge.
Okay.
And let's say, Michelle, you decide to take out money in that first year. You would think, oh, I just have a 10% penalty. Okay, I get to take that out, right? No, because of the market value adjustment, it could actually increase your surrender charge. And we'll drop a link below this video into a video that we did on the 10-year Treasury note. Okay. Most annuities are based off that 10-year Treasury note. As the yield goes up in that 10-year Treasury note, the market value adjustment in this annuity can also increase with it. Meaning we could have a massive increase. Look, we were up 160 basis points in the last 2 weeks in a 10-year treasury. If you have an annuity with a market value adjustment in it and you're looking to take money out of it, please go find somewhere else to take money out if you need it in an emergency, because you're going to get hit with a massive surrender charge. That's my personal opinion. But like I said, this could be a positive event.
Sure.
During a declining interest rate environment, the market value adjustment could lessen the surrender charges and actually, in some cases, Michelle, actually make you a profit.
Nice. Yeah.
And note, advisors that truly put their consumers first look for this loophole to assist their clients in growing their wealth. We have used this to our advantage and our consumers' advantages for decades. Understand, especially the last 20 years, we've been in a negative interest rate environment going down, right? We were able to help our clients get out of their annuities sooner. So.
Okay. All right. Anything else we need to be aware of?
Yes.
We're going to just.
Yeah, let's hit early withdrawal penalties. If you're under the age of 59 and a half, since MYGAs are treated like a retirement program, the IRS will hit you with a 10% penalty for early withdrawals prior to age 59 and a half. And the last negative for some people is it's not FDIC insured like a bank CD. Okay. MYGAs are backed by the claims paying ability of the insurer, not the FDIC.
Okay. All right. So you've mentioned we talked about withdrawal, penalty-free withdrawal under the advantages, and then just mentioned under disadvantages. I want to just discuss a little bit or have you explain with MYGA withdrawal options. Like what do people do and how does it work? What does it look like?
Yeah, so let's say, Michelle, we reached the end of our MYGA term. Okay, you're at full maturity now. Your 5-year MYGA's up. You got several different options to withdraw your money. Okay, and again, this could depend on the insurer too. So you may withdraw the principal and all the interest earned in one lump sum.
Okay.
But we talked about that before. We're tax deferred until withdrawal, right? So guess what's due?
Taxes.
Taxes. Okay. Also, you may be allowed to renew the contract at the then current rates. And third option is you may roll over or exchange your MYGA for another one without paying taxes on the gain if they're done properly with either a direct transfer for IRA money or using a 1035 exchange for non-qualified money. Again, understanding that you must have the right type of advisor that understands this process to stop you from creating a taxable event.
So you can roll over or exchange.
Yes, you can.
The MYGA for another without paying the gains if you've done, crossed your T's and dotted your I's, so to speak.
I mess that one up all the time.
Otherwise, you're going to have to pay that.
Yes, you are. So that's the 3 standard withdrawal options for most MYGAs out there. Some individual insurers, of course, may have other withdrawal options. Some of them allow you to turn them into income streams, but that wasn't the main purpose of MYGAs in the beginning anyways. They're designed for accumulation.
Okay. So if you mentioned if other insurers have different withdrawal options, this all is in the contract.
All in the contract. Make sure you read the fine print and ask before signing on the bottom line.
Okay. So one of the things when we've talked about annuities in the past, we've talked about even in retirement accounts, like it's important. What are the death benefit options for MYGAs?
Great question. Let me hit a couple rules here first that you should note with every different company, okay? Because there's so many different ones. So first off, each annuity contract, as well as any annuity insurer, the company, will have specific contract language regarding death benefit options. Please read that contract details closely. So, because there are some variances between companies that will make one company better than the other, even if the rates were exactly the same.
Okay.
So you have to know these death benefit payout options.
Okay.
And let's take another note. If you're a spouse of the deceased, you may have different death benefit options, including the right to continue the contract in your name to full term. If you have a current advisor and you run into this scenario, have them run to the scenario to see if this option makes sense versus transferring the assets into your name with a new annuity. But caution though, it may be in your best benefit at this time to receive a second opinion in this case. Anytime that and here's why. The biggest thing that we see is churning of annuity accounts.
Right.
And advisors flipping them over. We were able to bring on a new client by doing a second review, and there was no reason for the young lady to go into a new annuity when her contract had higher rates and higher benefits, better benefits for her, just to take over the account when her husband had passed away.
Got it.
Well, the advisor, knowing that the account was only 2 years old, there was high surrender charges,
Yikes.
but the surrender charges didn't come into play because of the death benefit.
Okay.
Well, there was no sense in writing a new contract for this young lady when we was able to preserve the account and lock in them higher rates and let her just take over the account. Nothing to do except for take it over. And so be very cautious with this. But
So
let's go into...
I'm sorry, real quick, Brian, I just want to
Yeah, go
clarify.
ahead.
I'm assuming when you say, it may be in your benefit to get a second opinion, you're talking about having another fiduciary advisor look
Yes.
it over, not a, what do you call it? Like a lawyer that specializes in trusts or anything like that. This is not what this is. This is about like having another advisor.
Have another advisor look it over and get a second opinion and then compare your options, honestly.
All right.
So, because we've seen everything. So
back to the death benefit options. Now that you clarified all that, what
yeah.
are,
So sorry, I had to hit them caution notes
that was
first.
great.
Usually I put them in the end, but it's that important to me that these are the gotchas when you're going through enough anyway, when you're losing a spouse or losing a family member, whatever, that you need to know this stuff first. But let's break it down to make it real simple. MYGA death benefit options are usually defined in two different categories: lump sum or income options. Okay. Let's explain each. So lump sum death benefit, when the insured passes away, their beneficiaries may receive the full account value in one lump sum.
Okay.
Some insurers will allow you to take out a 10-year payout of the lump sum to lessen the tax burden. Okay. That's common. And I've seen other ones that up to 10 years, this, that, and the other. That's the lump sum death benefit option. Second normal option and death benefits is annuitization or an income stream. So some insurers, Michelle, will allow you to create an income stream from the death benefit and have it dispersed over your lifetime.
Nice.
But you got to be careful here now. You got to watch the new inherited IRA rules. Qualified accounts must be liquidated in 10 years maximum. So at the most, you're going to get a 10-year payout on annuitization. So,
but that does really actually really help lessen that tax burden when you get 10 years rather than here, take it all at once.
Right. And again, when we come to this section, you really need to get a second opinion. That's my personal opinion over the years. So,
all right. So I understand that MYGAs are pretty much they're pretty simple, fairly straightforward.
Right.
Are there any risks?
Oh, yes.
With
There's
MYGA?
always risk.
Well,
Risk with many companies out there today. But think about this. With annuities and MYGAs in general, since we're speaking about MYGAs today, they're backed by the issuing company, which is the insurer. Your main risk is with the claims paying ability of this company.
Okay.
And can this insurer, Michelle, make good on all their claims? This is why before you purchase, you need to do the research of the ratings of these companies prior to signing on that bottom line, right?
So where do people go to research this?
We're going to put below this video, Michelle, a link to several of the main companies that you can do your research, like AM Best, Fitch Ratings, Moody's, and Standards & Poor's. Them are your top 4 that you'll see in the industry rating these insurance companies. And another place that you could go, Michelle, is to your state insurance department. See what the ratings of the company are. See how their what their claims paying ability are. How many complaints do they have?
Okay.
And look at that before you buy.
Okay. All right. So speaking of risks, are MYGAs, which multi-year guaranteed annuity, like, are they guaranteed as the name states, or can that rate change?
Okay. First off, the majority of MYGAs are a very safe product.
Okay.
Okay. So when you open a MYGA contract with an insurer, Michelle, you'll be guaranteed your principal first, and then the rate you're offered to sign up. So it might be, like I said, 3% for 5 years. Insurers must belong to what's called a state guaranteed association. And if they default, the guarantee association must pay you up to what your state limits are. Average is roughly $250,000. And we'll put a link below this video that goes to the state statutory limits of each state for every insurer. What happens in this situation, Michelle, is, how do I say this? In banks are, you always see that sign FDIC insured, right? Well, annuities, you don't see that. Okay, banks can put that logo out there, FDIC insured, but did you know that your insurance agent that writes annuities or sells annuities is not allowed to advertise that these are backed by state guarantee associations?
Really?
You asked the question, are annuities safe?
Yeah.
Are they guaranteed, as the name states? Now, since you asked me that, Michelle, I can answer with what I know, what the rules are. So you got to be very cautious on this. In my 25 years in the insurance industry, this is one thing you could never do, is advertise this, put this out there that is guaranteed up to $250,000. Here's how this works too. Let's say you got, in the state of Texas, we have thousands of insurers, okay? Each one of them companies pay into this state guarantee association. Well, if by chance one annuity or one insurer fails in the state of Texas, the other ones will step in, and one of them in the guaranteed association would take over the accounts as they are and continue the contract to the end of the term. And so that's how that program actually works.
All right.
But you're not allowed to advertise it.
Right.
But thank you for asking if they're safe.
Interesting. All right.
Because people ask that question, Michelle, that you're asking today, and they're like, I remember my years in the field, consumers would always ask, and well, I knew the answer, but I couldn't tell them until they asked me. So you'll start to see it's starting to loosen up a little bit, but they are pretty safe products. Just do your research and always get a second opinion. So,
got it. All right. Well, let's talk about taxation. So fun. How are MYGAs taxed?
Well, you know, Uncle Sam has to step in here, Michelle.
Always.
MYGAs are taxed, Michelle, based on the funds used to purchase. And are they qualified or non-qualified funds?
Right.
Okay. So remember, we talked about their tax deferred. Qualified funds, if you use qualified funds like an IRA, 401k, whatever, you'll be taxed when you withdraw the funds, and it's going to be considered income on both you get taxed on both the principal and the interest earned. That's qualified.
Okay.
Now, if they're non-qualified funds, like cash in the bank, okay, that's the easiest way to explain it, you'll be taxed only on the interest earned, kind of like a CD.
Got it. Okay.
That's simple.
All right. Well, let's talk about CDs. One of my questions I had, you mentioned early, very beginning when we started this, you said kind of sounds like a CD, doesn't it, Michelle? So one note I have is I would love to discuss, I mean, they seem very similar. So why would someone, I guess, why would someone choose a MYGA over a CD?
Or vice versa.
Vice versa. So maybe let's start with where they're the same, like where,
Okay.
what do they have in common? And then we can go into like where they're different. And then you can answer the question, like, why would someone choose a MYGA over a CD?
And this is very, very common, actually. And MYGAs, Michelle, are the insurance industry's version of a bank CD.
Okay.
It's that simple. Okay. So here's where they're the same. CDs and MYGAs both guarantee you a contractual amount percentage of return for a specific amount of time. I think CDs, you can do a 1 month and 3 month CDs now. So again, here's your interest that you're going to earn for a specific amount of time. Both of them do that. Both of them offer many choices of how long you want to lock in that. CDs from a few months up to 10 years, MYGAs from 1 to 10 years.
Okay.
Both fully protect your principal from loss. Both usually have no annual fees. Both can be held in IRA accounts, non-IRA accounts, Roth IRA accounts.
Got it.
Very similar.
Okay. So where do they differ?
Here's where they're different. CDs are backed by FDIC insurance.
Okay.
MYGAs are backed by the claims paying ability of the issuing company. MYGAs pay the advisor a commission, which does not come out of your principal amount. CDs, Michelle, pay the banker a salary.
Right.
So in non-IRA accounts, Michelle, CDs are taxed annually on the interest earned. Whether you take out the funds or not, you still will get a 1099 for the interest.
Right. Okay.
MYGAs grow tax deferred until withdrawal. There's the biggest differences between the two.
Got it. All right. Easy enough.
I got a little story on this one.
Sure. Tell it.
Because a real good friend of mine was in the bank, and she was licensed to do annuities and do CDs in the bank, right? So when someone comes into her office, depending on what they were doing, she would have to remove the FDIC little banner on her desk before she could write an annuity. And God forbid, if you didn't do it, you get wrote up for it. So that's the difference. You got to separate them as far as the guarantees. So
interesting. All right.
Kind of funny.
Okay, so I have one more question just about a comparison. So MYGAs are a type of fixed annuity, correct?
Yes.
They're fixed. So what's the difference between a MYGA and a fixed annuity?
Very, very simple. Okay. MYGAs are guaranteed for the whole amount. Okay. So 3% for 5 years, for example. Okay. Fixed annuities can offer you maybe a teaser rate in the early years and then lower the rates for the duration of the contract. Like, let's say for that same 5 years, Michelle, why don't I give you 5% for the first year and then 2% for the remaining 2 years to 5 years?
Okay.
It's not multi-year guaranteed because only it's guaranteed, but not at the same rate. So there's the difference between them. Not a lot difference, but you have to read the fine print. So,
okay. So I just have two more questions for you. You just mentioned rates. What are the MYGA rates? Like, what can people expect right now, and where do they find that information?
There's multiple sites across the internet that you can find that information. Just type in MYGA rates, fixed annuity rates. You'll see multiple places on the internet offering them rates. They don't change between company to company. The insurers change the rates, and they right now in this rising interest rate environment, they're changing pretty rapidly. So that's another caution if you're looking to buy them. Maybe you don't want to spend all your money to lock in today's rate when interest rates may be 1 or 2% higher a year from now.
Right. Or wait a little bit. Yes. Okay.
Yes.
All right. So my last question is, we've been doing these if you've been on this channel, you know how many annuity videos we do, quite a few of them, but we've never really done anything like this where we just did a deep dive. But you've mentioned before this idea of laddering, right?
Oh, yeah.
Like to ladder a basket of annuities. So is this part of like a retirement strategy would be to layer a MYGA?
Yes, and this actually happens in CDs too, Michelle.
Okay.
A unique MYGA strategy is to ladder a basket of annuities. And when one expires, you replace it with the next higher rate. And think about that. In this rise in interest rate environment, that kind of makes sense right now. So you try to do this to hedge against rising interest rates and what you don't want to do is lock up your funds over a long period of time for what may be a lower rate today.
Sure.
So if, like I said before, if the Fed's looking at raising 4-8 times this year alone, why would you lock in rates at 10-year when you can maybe do a 2 or 3 year and wait to higher rates? When it matures, you're at much higher rates. So that's what so for example, let's look at this. Let's say you wanted to buy $250,000 worth of MYGAs today. Okay.
Okay.
A 10-year rate, let's say, for example, it could be 4%, the 3 years, 2.5%, and the 5 years, 3.25%. We're in a rising interest rate environment. And a consumer may not want to lock up all their funds at the higher rate of 4% when short-term rates may be higher than that a year from now.
Sure.
So if they ladder or purchase different maturity dates with their funds, that's why they do this. Maybe they buy a 3-year, a 5-year, a 7-year, and a 10-year. And when the 3-year matures, they can buy another 3-year, lock in higher rates, and so forth.
Okay, got it. All right, makes sense. Thank you for explaining that. And that's when we talked about you can roll it, if it expires, you can roll it into another one.
Without paying the taxes on it, as long as it's done correctly.
Done correctly, exactly. All right, so this basically, if this is a strategy that people are interested in, you've got to stay on top of it, correct? You have to watch.
Yeah, you got to stay on top of the rates and your maturity dates. And also, this is where you as an advisor, if you're an advisor, you're watching this, make sure you follow up with these consumers. And here's what I do. I mark on my calendar every month. So the first day of every month, sometime during that month, if I have consumers that their annuities are maturing that month or they're being renewed that month and I have to reallocate, everything's marked that way. Follow up with these consumers, and that's how you stay in good with your consumers.
Just calendar it. Right? Okay. All right. So is there anything else on MYGAs that I did not ask that we should cover?
No, I think we're good. Just it's a word of caution with them. They are simple. They can still be confusing. And honestly, Michelle, I really, in 25 years of doing this business, I really wanted to make sure that we did a series on these for the amount they're being sold out there. Consumers don't know what they're buying most of the time. So
yeah, I want to make like a t-shirt that says annuities. It's not you, it's the contract.
I like that. We better hurry up and trademark that. Somebody's watching this video and they're going to be trademarking it.
It's so funny. All right. Well, on that note, we'll end this. Thank you for everything, Brian. Appreciate it. If you stayed to the very end, make sure to like this content and also subscribe and hit that notification bell so you never miss another video from us. And also stay tuned for our next video in this Annuities Exposed series. We're going to go through all of them, fixed, indexed, SPIAs, you name it. So if you're interested, you're looking for an annuity, someone's trying to sell you one, make sure you subscribe so you don't miss any more of these videos.
Definitely.
Thanks so much.
Thanks, everyone.